Assalamualaikum warahmatullahi wabarakatuh. We are back to look at the yen carry trade, or to be more specific, the unwinding of the yen carry trade as one of the factors that may have caused the heavy stock sell-off in the global financial market. So before going into that topic, we need to review the Japanese economy, at least to appreciate what may have caused Japan to have gone into this deflationary state that was going on for quite a long time, more than 20 years, since the stock market crash of 1987, where the Japanese economy went through a period of low prices, falling income, and low consumer spending. And we can see that the deflationary economy is not good, for the general people, or for the whole population. Because even though we may think that deflation is good for the consumer because prices are low, but we have to look at the other end of the equation, where businesses will be suffering a lot because when they are selling goods for lower prices, they will earn less profit. Okay, so when they make less money to compensate for that kind of opportunity loss, they may cut wages and lay off workers and spend less on innovation and capital reinvestment in the company. So we can see that this kind of economic malaise, will in the longer run be damaging to the overall economic activity. And of course, when there is low demand for goods and services, the money in the bank will stay as excess reserve, as idle balances, and therefore banks are flush with liquidity. As we say earlier, that there is low consumer spending because of Japan's aging population, and business are not keen to borrow because the incentive to make money is not there, because no matter what happens, business are not able to to increase prices because that has been the state of the economic system, where these low prices have demotivate businesses to increase their capital expenditure. So zero interest rate in Japan has prevailed for a long time. But the idea here is that when interest rates are low, or zero at 0%, in Japan, it does not ignite inflation, as what we see in the USA or in the rest of the world, when low interest rate, have increased consumer spending, have increased investment, when there is overlending and overborrowing, let's say, for example, during the US subprime crisis, so overlending and overborrowing create asset bubbles and inflation from the excess money supply, right? So this has not happened in Japan, and therefore this low interest rate in the USA have added more than $13 trillion of new loans and debt into the economy, sending inflation rocketing to more than 7%. But the low interest rate in Japan have done nothing to inflation, because deflation has been the state of the affair, but not in the US and the rest of the global market, where low interest rate will fuel borrowing and demand for loans, and that will increase spending till we have bad inflation. So to curb further rise in inflation, because we know inflation is again very bad for the economy, because it will produce adverse effect on profitability and the reduction in purchasing power. So inflation of 7% in the US is very dangerous, and that is why the Feds have been curbing the rise in inflation by hiking up interest rate from the almost 0%, right after the dot-com bubbles up to the US subprime crisis, and then we go to the COVID-19 era. So this zero interest rate policy has been going on for a long, long time until this debt has exploded to produce the bad inflation of 7%. Inflation would be a good number at about 2% or 2.5%, but at 7%, that is very damaging to the economy. And this interest rate hike was pursued by the Feds to its current level of 5.5%. And we know that in August, the bad data on output and unemployment have signaled, the coming of the economic recession from this interest rate hike. So they plan to combat inflation or to cool down the economy have somehow backfired into a slowdown of the economy overall. So there is a recession coming due to the maybe over hiking up of the interest rate. So the August stock sell-off across the financial market calls for Feds to initiate the monetary easing by lowering interest rate to prevent a recession. So we heard that the Fed will be meeting in September, and maybe they will be cutting down interest rate by 25 basis points. So let us look at the yen carry trade and how the unwinding of the yen carry trade, would be or have impacted the stock market. So we'll start from the initial standing, where we have the big gap between interest rate in Japan and USA, and at 0.1% in Japan and 5.5% in the USA. We assume that the exchange rate is at $1 US to yen 148. So we have the investor in US intending to borrow 100 million USD, and based on the exchange rate, $1 to 148, then that will be equivalent to 14800 million yen at 0.1% interest rate. So the interest payment on a yen loan would be at 14.8 million yen. So of course this yen loan will be converted into the USD, and the investor will go ahead to purchase the assets, stocks and bonds. Of course, this yen carry trade will be profitable, assuming that there is no change in the interest rate and there is no change in the yen. The yen value will be at that rate. So any increment in the yen or any fall in the yen or any changes in the interest rate in Japan will disrupt this yen carry trade. Let us see the first scenario, how the unwinding of the yen trade can occur. Let's say we saw that the Bank of Japan raises interest rate to 0.25%, and now the rate has gone up. So the gap between Japanese rate and the interest rate in US has been reduced. The exchange rate in Japan remain at $1 to 148. Of course, we will see later the yen will go up. As usual, when we have higher interest rate, the currency will follow suit. And the investor who is borrowing 1,480 million yen have to now pay the loan at a higher rate of 0.25%, and the interest payment goes, from 40.8 million yen to 37.8 million yen. So this may have caused the investors scrambling to service the more expensive yen, leading to the stock sell-off. Right? So when we look at the second scenario, the appreciation of the yen as interest rate goes up. So we see that the higher interest rate in Japan by 25 basis points is partly due to the higher wages in Japan that may have inflated prices. So the Bank of Japan came in to intervene to soften this price level increment. Some say that the Bank of Japan needed to raise the yen, which has been sliding down against the USD, that has been hurting Japan's oil and food import. So, the lower yen is good for Japanese exports of their Toyotas, their Lexus, and their Sonys, but it will be, it will have adverse impact on the Japanese oil and food imports. So, in scenario 2, yen appreciates as interest rate goes up. So yen goes up as the Bank of Japan raises rates. Among others, the demand for yen increases from the rising demand for Japanese bond. Of course, we have, this higher interest rate will attract investment to purchase the yen bonds because of the higher yield. And this, of course, have increased the demand for yen, and that have caused the yen to appreciate. So the investors, let's say the dollar fell to say $1 to yen 143. Investors panic for liquidity to pay off the more expensive yen loan. So most stocks sell off. For example, the investor A has to pay back yen 148.00 million with a higher USD of 103 million instead of the USD 100 million where yen is at $1 to yen 148. So this is how the unwinding of the yen carry trade due to the increase in the interest rate and the yen appreciation, they have caused this yen carry trade to be out of the money to the US investor. Hopes this will explain a bit about the current situation in the stock sell-off in August. Inshallah, we will meet again. Assalamualaikum warahmatullahi wabarakatuh.